Good morning, everyone. Happy Wednesday. I'm Irene Snivesky over PC. I'm here with Jane Lovofsky at Supporting Strategies. Today we're going to discuss how to maintain a profitable business in today's world, especially when it comes to the difficult hiring market that we're in. And of course, in today's world, and the last, it seems now almost coming up on 2 years, it has been very, very difficult to retain employees, and we've even read some articles on how some employees are accepting positions and then they simply don't show up, or sometimes they hold the position and then they would switch over. And so the recruiting fees, when you start thinking of all those fees associated, when you start thinking of all the additional fees and costs that it takes to run a business, I'm going to just talk a little bit about what to keep in mind from an employment point of view, given thinking and keeping in mind all these issues when it comes to employment. And so some of the things that we talk about with some of my clients of how to make this market, how to really be able to navigate it and how to make it work for you is we've discussed the option of, for some positions and for some employers, to be able to have a lower, of course, more than minimum wage, but a lower starting salary or starting wage and higher on the bonus side. It incentivizes the employees, it ensures that you have an active workforce, and certainly it ensures that the employees that are there aren't really just coming in just for a short period of time. They're really there to stay in the company and to work towards those bonuses. And so when you look at this from a financial point of view, you might ultimately pay the same amount of money. And so none of this is to save any amount of money. It's really just to ensure that you're remaining profitable instead of having to pay a large recruiting fee up front, pay a large amount up front of a regular wage. And of course, if you do that, if you pay a larger amount on a regular wage, if this is an hourly employee, then what happens is you of course have to pay a larger amount in overtime, because the overtime will be time and a half of any regular wage that you pay. And so keeping that regular wage low will help to ensure that any overtime the employee works likewise isn't going to be in a ballooned amount. And of course, it could still be calculated as such that a discretionary bonus would possibly account for anything additional that you may have in a different market paid to the employee. What we've seen also now as both a effort to ensure an active workforce and not to have any breaks in time in the workforce, but also really to incentivize more employees is on-call pay. And so if an employee will remain on call for a certain weekend, and then you have a policy in place that you need them to come in that weekend, and they do also receive a certain premium for being available, being on call, and showing up. Helps you keep everything running smoothly, and really that on-call pay, the premium difference of which is being paid in comparison to the amount that could possibly be lost of having a business at that time that is lacking those employees. We've found that the difference, businesses typically make that back immediately. And another thing is that a lot of employers have been asking us lately has to do with holiday pay. And holiday pay, everyone is very surprised that it's not a requirement to pay holiday time or holiday days at an inflated rate. And so although you can do so to retain more talent, and it is an additional benefit that you can provide, or rather, not a benefit as you would imagine the term benefit to be used, really just a bonus incentive. And so that holiday pay can be paid at a larger rate to, again, ensure that your workforce is active and to ensure that you're really being staffed. But it is actually not a requirement that you increase any pay during holiday time. So you actually can have a policy of incentives to do that. And so I do want to switch gears just a little bit. This is a bit about the employment side when it comes to remaining profitable, both from a point of view of how much to pay as well as how to stay staffed so that you can continue to remain profitable and continue to remain in business. But I do want to ask Jane, in terms of the different side of it, how would you track financials of a business?
Hi, everyone. Irene, thank you. You covered so many great points. I mean, just the other day, I was asked very similar questions, and I think it's really important to make sure that you're compliant, right? And then the other side of obviously making sure that you retain your employees. So the side of kind of what we deal at supporting strategies with is actually tracking financials, right? Making sure that the owners have the financials, but then also taking it sort of to the next level. And a lot of times I feel like I mentioned the term key performance indicators, KPI, and then I decided that it might be a good idea to actually show what I mean. So I created this sample report. It's not for a client. Um, and I think I'm just going to move us so we could see a better screen. So the key performance indicators are something that deal with different tabs, right? Profitability, which I'm going to talk probably the most on. So we would track total revenue and then the gross profit margin, which is really important for businesses. And what we would do, we would set up KPI towards a certain revenue goal, like a target, which is right here. So we put for that month 641,000, which is probably prorated for the annual goal. And then we track what the company actually made in that month. And then we see that we're off, right? And this is something that is very critical to us because this is what we set up as a key performance indicator that is really important, that the revenue is on target. And so what we would do is we would track it versus, previous month in the same year. We could also track it based on different quarters and see what the trend is, what we need to increase, right? So revenue would be the most critical point for many businesses. So this is how we would track it, one of the reports. And then also the gross profit margin is extremely important for a business. So this is something 56.57% is something that we set up for that specific company, but a lot of times it's about 40%. So it's basically what we decided at that time, what we're trying to target. And obviously the profitability ratio, but one of the most important KPIs that I think is important to know for any business is wages to sales, how much you're actually spending for wages. So in this, we decided that it's 15.7%. Most of the time, I would say about 20%. 20 to 30%, depending on the type of the business. And then you could also set up a rent to sales, which could be again important. So 6.4% for this specific, and that's a low importance. But these are some of the profitability targets that we could set up and actually see what's the percentage of that and whether you actually make it in each month. So if you have a stable rent and it's about similar percentage, it would just be sort of like a reflection of how much you made that month and going back to the revenue total sales. We could also do different other parts, which a lot of times we don't really get to as much because we're really trying to track profitability. But a lot of times if it's a growing business and we're trying to sort of have a really significant growth in a certain quarter or a year, then we're going to track a growth, revenue growth and the gross profit growth. And then basically you want to set up the percentages you want it to be. And I'm going to show you other reports that we could take a look at and how to track it better. So we could also do this sort of on track KPIs, which we've put all of these on track, meaning that you've succeeded at the goals that you put for yourself. And so they all are going to be appearing in green, and we're going to talk about, how well we did. But a lot of times we want to concentrate on the off-track KPIs, something that we didn't hit the target. So for example, if your wages to sale are too high for that month, we want to see what happened, right? If the wages too high, what are we doing with that? And this kind of goes back to what Irene was talking about, wages and making sure you're compliant, but we want to make sure that you're still profitable after all the compliance. We could sort of set up the revenue analysis and see and compare it to previous years. So I know a lot of my business owners like to see that. They like to compare previous years, quarters, and different graphs of, it's really helpful to see it visually. Again, same thing with the revenues and the expenses. So we like to see what are the top 10 expenses. What are we actually? So most of the time it's going to be, the cost of sales, but then the other part of it, most of the time I see this is salaries and wages and I guess advertising for a lot of the businesses, which is also here as well. but I feel like these are very typical top 10 expenses. If there's something else, then we would probably take a look at that and see why it made the top 10 expense. But most of the time, the top one is the salaries and wages. The profitability margins, it's really crucial for any business. So we talk about the break-even point, right? We want to make sure that each business owner knows how much they have to make to cover all the fixed costs, everything that absolutely is recurring each month. We want to make sure that they know that this is a certain cash flow that they need to have in order to hit the targets. And again, we're going to take a look and compare the revenues with gross profits to, basically you could compare it to months, quarters, but we could set it up differently. And this is the break-even point that I was talking about. So basically for this business, the break-even point, so they absolutely have to have 503,863 just to make sure that they have enough to cover their expenses. The fixed costs, like I said, is something that's predictable, fixed every month. Variable costs is something that could be extra for that specific month, but that's why we have this margin of safety to make sure that there is enough. And so once you get over the break-even point, you're basically in the plus. If you make anything below that, you're in a minus. But these graphs and kind of these calculations help business owners understand where they are. We also like to look at cash flow, but sometimes it's a bit complicated with the cash flow because it takes into effect certain expenses, different changes. And I think this is one of the more complicated reports for people to look at, but it also is helpful to look at just the sort of the numbers of how much cash you need to have. But I do think that most of the time, business owners just want to have like a total amount of how much they should have instead of analyzing this part. And this is, again, a very helpful tool for some businesses, not for all, actual versus budget. So if you have a budget set up for how much you want to be making, how much you want to be setting up for sales, how much you want to be spending, and then you compare it to what actually happened. This is a great report to compare and the variance and see how well you did. But again, it's not necessary for all the businesses. I think most of the businesses could benefit from this first one, the KPI results, especially the profitability, and tracking it and seeing it. Because one thing is kind of telling yourself, oh, I think I'm hitting that. Oh, I'm doing great. But when you look at these results and when you compare it, sometimes it might not necessarily be as you think. So again, if there is any further questions or anybody would like to see a copy of this or kind of find out about certain of these key performance indicators, we would be happy to, help you out with that. And if there's any questions for Irene and any of the things that are happening in the employment law, we'd be happy to answer that as well. Thanks, everyone, and have a great day.